So in our last class, we commenced a new topic known as working capital management. Working capital management. In that class, we described working
Good
capital
evening, sir.
as the difference between current assets and current liabilities. And we said working capital is the amount required for the day-to-day running of a business. And working capital management, we said, represents the efficient management of each component of current assets and current liability, such as inventory, account receivables, cash, prepayments, accounts payable, and so on and so forth. We said in order to ensure the liquidity of the company at all time, there is need for proper working capital management. And we said that the primary purpose of working capital management is to ensure that the company always maintains sufficient cash flow to meet its short-term operating costs and short-term debt obligation. So we look at the working capital cycle, talking about how we use our cash to get raw materials. The raw materials, some instance, can become work in progress. Work in progress will now move to finished goods. When the goods are finished, you sell them out to your customers. It can be in form of credit. And when it is in form of credits, it becomes receivables. It becomes receivable. So as you get back your money from your debtors, it becomes cash. So the revolving of these items of working capital is what is termed as working capital cycle or operating cycle, cash operating cycle. So we solved the question and we presented an assignment which almost most of us have solved. It's a good one. For those that have one or two errors, I've private chat them to correct those errors. So tonight we are going to pick one aspect of the working capital and we're going to be talking about inventory in today's class, talking about inventory management. When we talk about inventory management, we are simply referring to a method of ensuring that the right quality and quantity of the relevant stock is available. That as an organization, you've been in existence and you've set a standard for yourself. For you to be able to meet up with your expected standard, you should know the right raw material to get and at the right location to get them. So the process of overseeing all this activity is termed as inventory management. So it's a process of controlling a company's stock of goods. And the stock of goods can include what? Raw material, work in progress, and finished goods. And the essence of inventory management is to ensure that the right quantity of inventory is available at the right time without trying or tying up too much money in stock or running out of stock. So it means that you must ensure that you present or you make available the right quantity of material. That is, if you need 30,000 kg of a product in terms of raw material, you should ensure that that 30,000 kg is available, not you having less or having more. Because when you have more, that stock, you are not just getting it free of charge, you are using money to obtain it. So instead of tying the excess down in terms of in your warehouse, and you keep incurring warehouse costs, holding costs, that is not right. So you should work based on the principle of just-in-time system, that the right quantity that is needed is the right quantity that you've ordered, and it is in the right quality likewise. So the essence of inventory management is to avoid stock out. Stock out. What do I mean by stock out? Is to ensure that products are available when customers need them. So in some organization, you discover most times they can't produce because there is no raw material. Maybe because the raw material is seasonal. And even when raw material is seasonal, a proper inventory management should be put in place, whereby an organization can always have all season stock. Even when the raw material is out of season, there should be a way of preserving the raw material that will continuously have it all year round. So that is the essence of inventory management. Some persons are faced with this particular task daily in their organization, where they have to take stock of raw material to ensure that they don't go out of stock, and to ensure that they meet up with the customer's demand daily. So that is why inventory management is important. So it's not just a topic just to read and pass exams. You can find yourself in an organization where this knowledge can be useful. Even in your house, you apply this concept, inventory management. It's not when the rice finish, you now shout, "Hey, whoa, the rice has finished." It's because you are not a good inventory manager. So when you are a good inventory manager, you know the right time to restock things, even in your household. Yes. But when you just live like that without taking control measures about the stocks of things within your possession, you can always be out of stock, and you begin to knock at the next door neighbor for one or two things. So because there is poor inventory management. So the the concept of inventory management and why it is important is because it also helps to minimize costs. It helps to minimize cost. If you get the right stock at the right time, it will help you to reduce storage costs. But if you get too much quantity that you don't need at this point in time, it means you will incur storage costs. But when you get the right quantity, as at when it is needed, it means there will be no need for you to incur more costs. And when you incur storage costs, when you are keeping those goods in your warehouse, you need to, if you have an insurance cover, you also pay an insurance fee. Likewise, if you have an insurance cover, aside the storage cost, sometimes those goods you get in excess, they might not always be in frequent use, and they can become obsolete due to passage of time because you don't use them often. So you discover that the money you are supposed to use for something else, you tie it down in a stock that is not relevant for your daily operation. So this is why inventory management is very important. It's very key in an organization. Number one reason I mentioned that it helps to avoid stockouts. Number two, I said it helps to minimize costs. And more so, I can say that inventory management helps to prevent too much money from being tied up in inventory. It helps to prevent too much money because, as I've said, just to reiterate, what I've been saying, that when you have proper plan, when you have proper plan of things, of how you want your operation to go, you will know the quantity of stock required per time. So instead of buying too much, you buy what you need at that point in time. So it helps to optimize cash flow, and it also helps to improve customer satisfaction. What do I mean by this? When I come to your factory and I request for certain products, and you are giving me excuses, today you are telling me that Oga, the supplier no supply this thing. Tomorrow I'm there again, are telling me stories. I will look for another way to get what I need. So, but when I always come to your factory and you always meet my demand, I'll be very pleased with you. I'll be happy. And that's what I'm getting. I'm getting satisfaction. So it helps to improve customer satisfaction, because when you give me my goods as at when needed, I will develop trust in you, and I'll be very happy because of your timely delivery and of your quality service. But when there is no proper inventory management, a customer is here today, you are telling stories. Here tomorrow, you are telling stories. The subject matter is you are not a serious organization. So, and you tend to lose that customer, tend to lose that customer. So I believe we all know types of inventory. You know types of inventory, right? I've mentioned it in this class just now. I just want to test your understanding. What are the
Yes,
various
sir.
inventory?
Shall we know?
Okay, mention them, ma.
Okay.
Just
Raw
in time.
Inventory
material.
of finished raw material, inventory of
What is
work in progress, and inventory of finished goods.
it?
Okay, somebody was trying to tell me just in time. So can you expatiate on that, just in time? Who is the person that wants to tell us about just in time? But the three types of inventory you should know is raw material, work in progress, and finished goods. And finished goods. So let me speak to my slide. So based on the slide, I put that inventory management, that this involves the method of ensuring that the right quality and quantity of the relevant stock is available at the right time and at the right place. So inventory is the raw materials, work in progress, and finished goods that are considered to be the portion of a business asset that are ready or will be ready for sale. So inventory represents one of the most important assets of a business, because the turnover of inventory represents one of the primary sources of revenue generation and subsequent earnings for the company's shareholders. So this is just to corroborate what I've been saying over time. Now, why do we hold inventory? I've also talked about this in a way. Why do we hold inventory? The following are some of the reasons for holding inventory, and these include, just as we have motives, reasons for holding cash, that you know, in that you talk about transactional motive, speculative motive, and what?
Precautionary motive.
Very good. Precautionary motive. So also when it comes to inventory, you ask yourself, why should I hold inventory? Why should I hold inventory? Number one is to meet regular demand. To meet regular demand, so that you always have stock to give to your customers. But when you don't have proper inventory policy, you definitely run out of stock. So you need to hold inventory to meet up with regular demand and to ensure smooth production run, so that you not be producing and they will tell you that the store man will tell you there is no more raw material to produce, means there will be production breakdown. So in order to ensure smooth production run, you must always hold inventory. Always hold inventory based on what is required at a particular point in time, and to even out seasonal variation in demand. Yes, because as I've said, some raw materials are seasonal in nature. You get them in large quantity at some point in time. At some point in time, they'll be out of stock. So based on trend analysis, you should be able to identify that at this point in time during the year, there will be shortage of this raw material. What should we do as an organization to ensure that we have all year round production is based on our what? Inventory management policy. Inventory management policy. So a very good organization should not run out of stock as a result of the fact that the raw material they use is seasonal. They should adopt a technique whereby they can have the raw material all year round. And another reason for holding inventory is to take advantage of bulk purchase discounts. Maybe there's an opportunity for you that when you buy 1,000 units, you get a discount of 1%. When you buy 2,000 units, you get a discount of 1.5%. So you want to seize that opportunity, and that can be another reason for holding inventory, and to take benefit of unexpected scarcity in the product. So when there is a forecast that this raw material we go into scarcity in some months to come, one of the ways is for you to quickly stock your warehouse with required quantity that will take you through the period of scarcity. Yes, so that you will not be out of business within that period. So these are some of the reasons why we hold inventory. So it's a very serious matter for organizations that are into manufacturing and production, because this is a driving force of their business. Once the raw material is not available, there is no revenue, there is no production. It is when there is raw material, there will be production. It is when there is production, there will be sales. And when there is no raw material, it means there will be no production and there will be no revenue. So based on my slide, I'm speaking to my slide, talking about the objectives of inventory control, which I've also mentioned that the objective of inventory control to minimize risk of loss due to obsolescence or deterioration. So there are some raw material that you cannot keep for long. Some raw material can be perishable, means they are subject to deterioration. Some raw material are technological in nature, that if you keep them for too long, time will render them useless. For example, there was a time we were using some kind of chargers to charge our phone. As of today, some of those chargers are no longer relevant. Yes, because now people are using Apple products. So chargers, you won't get them, made them to fade away. So these are objectives of inventory control: to minimize capital investment in inventory by eliminating excessive stocks. So you should know the right quantity to get per time, so that you will not put too much resource in getting excess stock that you don't need at that particular point in time. So this the reasons, and also to minimize the cost associated with inventory. When you get inventory, you are not just keeping them. You get somebody to take care of them, to watch them, to count, stock counting, to ensure that there is no theft, there is no pilferage, there is no destruction on those raw material. All these processes involve cost. So by the time you try to see how you manage your inventory by not incurring too much cost, it will also help the organization, and it can also be an objective of inventory control. And to minimize the risks of under and overstocking, this is also an objective of inventory control. Now, the point is, when there is control, you know what to get per time. But when there is no control, every quantity will look like the best. But when there is control, you know the right quantity per time and per season. But where there is no control measures, there is no check and balance, everything you do will be all right. So also, to supply the required materials continuously, is also an objective of inventory control. So when there is control, when you are about to go out of stock, you will know. The reorder level will signal you that it's time to make an order, to place an order, and you do that in that respect. I said, note, the overall objective of inventory control is to maintain stock levels so that the total relevant cost of inventory are at minimum. Take note of this statement. Take note of this statement. Why am I saying take note? When we try to solve an example and you are given 3 levels of inventories in units, and the examiner is asking you, at what level should the organization purchase? Should they purchase 400 units, 500 units per order, 600 units per order? When you do your computation, the lowest total cost based on your computation should be what you should advise the organization to go for. So I said, note, the overall objective of inventory control is to maintain stock levels so that the total relevant cost of inventory are at minimum. So the cost of your inventory should always be at minimum. At minimum. Where it is at maximum, it means you are not doing a proper inventory management. So based on this, what are the costs associated with inventory? The costs associated with inventory. The cost associated with inventory management. Now, we have one, ordering cost. Ordering cost. Ordering cost. When we talk about ordering costs, these are costs incurred when placing an order up to the point of receiving the goods into your warehouse. So every cost associated with placing the order, even the call you are making, the cost of that call you are making to your supplier, that please, I need 500 units of this product. The van that will bring in the goods to your warehouse, the people that will move the goods from the van to the warehouse, all those costs associated with it make up ordering cost. Because in some question, they will not just give you ordering cost as a collective noun, as a name to cover for those activities. They can bring some activities. They can tell you transportation cost. They can tell you communication cost. They can tell you cost of loading or offloading. They might not tell you ordering cost directly. So you should know that the nature of ordering cost constitutes what? Things activities, actions that involve moving the goods from the source of raw material, from the source of purchase into your own warehouse. Those costs, those elements of cost make up the ordering cost. Take note, some questions will not just give you free of charge, ordering cost. They'll put so many things. They'll tell you cost of issuing the purchase order. They'll tell you transportation costs. They will tell you communication costs. So it's you that will now add all these costs and you get your total ordering costs. So in a question, don't always look for ordering costs directly. So you read the question and see what the question is telling you. So examples of these ordering costs, let me see if I have them in my slide. Okay, it's not there. Let's improve on this. So example of ordering costs, we can have, yes, Mr. Michael.
Yeah, please, can you help me? I just want to take a note of that number, I mean page 4. On that note, there's something I want to note before my network throw me off. Please, can you just help me? Just take me there a bit, please. Thank you. Okay, I've gotten it. Thank you so much, sir.
All right. So ordering costs. Let me use another slide for it. Ordering costs. And we talk about ordering costs. I said these are costs. These are costs. These are costs. These are costs incurred when placing an order up to the point of receiving the goods, to the point of receiving the goods into the warehouse. And these costs can include, let's say they include the following. You can have one, we can have costs of issuing purchase order. And what are example of these costs? You can have people working for you, placing order, but they are not permanent staff. You can have, depending on how you operate in the organization, you can have remuneration of purchasing department staff, because that is their work to place order. Remuneration of purchasing department staff. You can have another cost to be transportation costs. You can have another to be costs of getting to the supplier. You know, when your organization sends you to a place, you will tell your boss, where you don't have an official car, please. Or even before you say please, the the boss will give you the transport. So transport fare. So cost of getting payment to the supplier. And yes, when you are paying the supplier, there are some costs associated, especially in these days for those that do financial statement analysis, where you are trying to analyze your financial statement, the bank charges, all those things costs you have to consider. Likewise, communication costs. I know most organizations might not be doing that. You can have cost of loading or offloading. Cost of loading or offloading. So these are some costs associated with ordering cost. Now we have carrying or stock holding cost. Carrying or stock holding cost. Carrying or stock holding cost. Can tell us something about this? Carrying or stock holding cost. Let me continue my discussion. Time will come, you will talk. So when we talk about carrying or stock holding costs, when you bring the goods to your warehouse, do you just leave the goods like that? Do you just leave the goods like that?
Storage costs. You store it in a warehouse.
Yes. Yes. So this carrying or stock holding cost, in order not to waste much time, because we need to solve an example and you also need to solve a classwork. So these are costs. I would say these are costs. These are costs incurred. These are costs incurred whenever material is stored in the warehouse. The cost of maintaining those goods in the warehouse. So the carrying cost can be, we can have costs such as insurance and audit costs. Who can speak about this? Insurance and audit costs. How is it related? Some of you work in manufacturing firm, so speak to this. Insurance.
Can I try, sir?
Yes, you are not just trying, you are speaking rightly, sir.
Okay. For insurance, most companies would always insure their goods so as to take advantage of probably unexpected events like fire outbreak and all of that. And then when it comes to audit, especially some manufacturing firms, most times they may have external auditors who will come and check their process, the process of issuing their stock out, and then to ensure that the stock are being issued out and then being received in the right way it should. So I think the cost of this exercise would definitely impact on the cost of storing those goods, because most times we may have stock, like we have physical stock which may not tally with the system balance. So in the process, they may invite external auditors to come and check if the two are corresponding. So if there are any discrepancies, then they will know how to go about it. So in that case, the cost of this exercise, of course, is an operating cost, which they will pay those who will be involved in carrying out the exercise, the audit work, and then the amount that we pay to insurance company too.
Yes, thank you very much. And no, I said you said you want to try. I said no, you are not just trying. You speak rightly. Yes, so that is it. Yes. So just as you have said, I know I once worked in such organization whereby it's all about stock. It's all about stock. So most times when we have our auditors from the head office, before they arrive, we make sure we tally our system balance with our warehouse balance. And to do that, we ensure that we take our stocks every 15 days. 15 days, and at the end of the month likewise. So before those auditors arrive, we make sure that our stock on our system is rightly placed based on the appropriate SKUs and the rest of it. So the costs of maintaining those goods in the warehouse, you always see warehouse damage. Warehouse damage is a cost on the organization. If we are not keeping those goods in the warehouse, we incur warehouse damage. Sometimes you even get issues like transit damage. Yes, as those vehicles are bringing those goods from the head office, from the manufacturing point, because of the nature of our roads, you see so many transit damage. So the insurance and audit costs, there are costs that you incur by holding those goods in your warehouse. If you are not keeping those goods, you will incur this cost. And that is why most organizations are now using the just-in-time system. The just-in-time system. As we need the goods, we produce and we sell. We don't keep goods in the warehouse. So as we receive order from the customer, we produce and we dispatch. So instead of having one warehouse to store goods, no. So they work based on just-in-time system. So we can have insurance and audit cost as a form of holding cost. You can also have warehouse maintenance. When it is rainy season, you begin to see the roof of the warehouse experiencing some leakages. You now call for maintenance. Warehouse maintenance, or where you discover that certain reptiles are invading your warehouse, it will call for maintenance. Warehouse maintenance is a form of holding cost. And as I've said, that definitely you cannot store goods and you won't experience damage. Yes, so you can have warehouse, can have damages. Can have damages and pilferages. So damages and pilferages. So where you have these damages is a cost. You will just throw those goods out. So we have a voucher we use then. Yes. Warehouse damage. We record those items in those booklets, and we enter them into the system so that the head office can pick them likewise as damage in our warehouse. So there is a cost for it likewise. There is a cost for it. So you don't just those damages are costs. If you are not keeping those goods in the warehouse, you will incur those costs. So, but because you are storing those goods in the warehouse, they are holding costs. They are carrying costs that you incur. So we have documentation costs. Documentation costs. If you are not keeping those goods, you will incur documentation costs. Yes, the cost of the booklets, all you are producing for warehouse, your bin card, all you use in your warehouse, your pallet and the rest, your documentation costs. That is when you are taking you are doing your stock taking. And also, if the warehouse does not belong to you and you are paying rent also is a holding cost. even when you are paying, even when it belongs to you, you should recognize the cost of that place, the building. And also, okay, what I want to say, I think this is fine. This is fine. So these are carrying or stock holding costs. They are carrying or stock holding cost. So we have stock out cost. What is stock out cost? Stock out cost. Before I speak on that, what is stock out cost? Though I've explained that while I started my introduction, I just based on the background of the discussion. So what is stock out cost?
So I think stock out cost is the cost you okay, what you're going to lose when you don't have enough inventory to meet up with your customers' needs.
Okay, fine, very good. So what are those things you will lose?
Repetition.
Very good, repetition. I mentioned some of these things, yeah. Repetition. So
Customer.
yes, you lose your customer, loss of turnover, loss of goodwill. And if you are a very good staff and you discover that this organization, they are not always producing, they are always running out of stock, you might decide to get another organization that are up and doing. Because when your organization is producing today, not producing tomorrow, one day they can just ask you to go because they will think that the cost of paying you is too much. What are you doing? Understand? So it can lead to loss of qualified staff. And more so, when you lose that qualified staff, your secrets will be made available to another organization. So loss of trade secrets to competitors as a result of what? Losing the staff. Because the knowledge the staff have gained in the organization will be transferred to the new one. Yes, and that is why most times when you're an applicant, they will be asking you experience. Yes, because they know experience is very important. So because you bring those accumulated experience into the new role you'll be playing and you perform much more better. So stock out costs, these are costs incurred. Let's write so that we'll stock out costs. Where is it? Stock out costs. Stock out costs. Let's say these are costs. These are costs incurred when customers demand cannot be met because of what? Because the stock is exhausted. Because the stock is exhausted. So now, and what are the stock out costs? These can include, they include, let's say one, they includes loss of turnover. Loss of turnover. And also include loss of goodwill. Loss of goodwill. And also include what? Loss of qualified staff. Loss of qualified staff. And also, let's say four, and it's a loss of trade secrets, loss of trade secrets to rivals, to competitors as a result of what? Arising from loss of staff. Arising from loss of staff. So this is the stock out cost. The other one is purchase cost. Purchase cost. So when we talk about purchase cost, what are we referring to? Purchase cost. What is purchase cost?
The actual
Purchase-
amount
I
you
think
pay for the goods.
Is the total amount you incurred
I-
using an inventory?
Okay. So purchase costs. Madam Alicia,
Sorry, sir. I wanted to see the previous this thing. Let me screenshot the previous stock out cost that you wrote, sir.
so when we talk about purchase costs, we're talking about the
I'm true. Thank you, sir.
we're talking about the actual costs. That is let's say this is the actual cost of the items. Actual cost of the items placed in stock. The actual cost of the items placed in stock, that is the cost of obtaining the goods. You know, purchase cost is different from the sales cost per unit. So when we talk about this purchase cost, the per unit cost, per unit cost of the item, per unit cost of the items may vary. Why will they vary? May vary with some quantity discounts. With some quantity discounts, when you are buying in large quantity, the cost per unit can vary with quantity discounts, or it may be fixed. If no quantity discount is allowed. If no quantity discount is allowed. So this purchase cost, let me add something now, that this purchase cost, this will lead us to the next point of our discussion. The purchase cost per unit. Purchase cost per unit is used in the determination. It's used in the determination of economic order quantity. It's used in the determination of economic order. When we talk about economic order quantity, that is EOQ. EOQ is the optimal quantity of stock is the optimal quantity of stock a company should order each time, so that the total inventory cost is minimized. It means that if you need to produce, or you need 1,000 units of raw materials in a year, how many times should you purchase this raw material? How many batch should you have in a year in order to what? To minimize your cost? Instead of buying today, buy tomorrow, buy next week, you should have a plan that if I should January, February, March, what is the cost? What cost will I save compared to if I should every month? So this economic order quantity within a year. Optimal quantity of order each time so that the total inventory cost is minimized. And what is the total inventory cost? The ordering cost and your what? Your holding cost. The ordering cost and your holding cost. Based on this slide, let's see what we have put there. The economic order quantity, we said this is the level of activity at which the cost of inventory control is at minimum. Yes, it is the point where your cost should be at minimum. So it is the quantity of stock which is normally ordered each time the stock is being replenished. So economic order quantity is an equation for inventory that determines the ideal order quantity a company should purchase for its inventory, given a set of cost of production, demand rates, and other variables. So this is done to minimize what? Variable inventory costs. It is done to minimize order quantity. There is a formula. Let's see. Okay, fine. I think I have the formula here. There is a formula. But before then, there are assumptions related to economic order quantity. And one of the assumptions is that purchase price is known and constant. Purchase price is known and constant to be given to you in the question. They will not tell you that it varies, it fluctuates, but there can be a discount where you are buying above certain level of quantity, above certain quantity. You are buying above 500 units, they can give you 1% discount. So purchase price is known and constant. Annual demand is known and constant. So the annual quantity you want to buy will be given in the question. And ordering cost is known and constant. Likewise, all these will be available in the question. Carrying cost is known and constant. But in some questions, they can tell you that the ordering cost is 10% of the cost per unit. So just for you to look for 10% of the cost per unit. But definitely it will still be constant. And that replenishment is instantaneous. These are the assumptions of economic order quantity. Now, this economic order quantity, there are two basic approaches to solve questions on economic order quantity. But I know it is one that they want us to hold forth to. You can use the algebraic approach and you can use the graphical method. But for the purpose of this class, we hold forth to one. That is the algebraic approach, which I believe most of us should know, which is economic order quantity is equal to what? The square root of what? 2 multiplied by the annual demand multiplied by what? The carrying cost. Multiplied by the ordering cost divided by the carrying cost. So it's a formula that if you've done normal management accounting, you will have this is the formula. This is the formula method. And it is in your book. Please write this square root very well. it is 2 multiplied by what? D multiplied by CO divided by CC. And what is the meaning? D is what? Your annual demand. CO is what? Your ordering cost or cost per order. And CC is what? Your carrying cost or cost of holding 1 unit for 1 year. So the total annual relevant costs are what? The total annual relevant costs, they are what? They are the total holding cost and the total annual holding cost. I've mentioned this before, where I said that the total inventory costs are the ordering cost plus the holding cost. So we'll look, let me see, yes, we'll look at this example to explain. We'll use this example to explain ordering cost, economic order quantity rather. Yes, in the simplest way. So I'll read that a company requires 1,000 units of material S per month. 1,000 units of material S per month. The cost per order is $30, regardless of the size of the order. Either you are making an order of 1 unit, 2 units, the price remains constant. So the holding costs are $2.88 per unit per annum required. Investigate the total cost of buying the material in quantities of 400, 500, or 600 units at one time. What is the cheapest option? Use the economic order quantity formula to prove your answer is correct. So what we want to do, all we need to do first is to determine our order quantity. We have 3 options here. We have 3 quantities of material: 400, 500 units, and 600 units. That if we are to purchase 400 units, what will be the total cost? If we are to purchase or order for 500 units, what will be the total cost? If we 600 units costs, what? Now, it is when we know the total cost, we will now use to confirm our results, to confirm our results. Let's see what to do now. Please screenshot the question in case you don't have it, so that we'll not be moving up and down.
So sorry, please go back a bit to the question. Thank you.
So looking at this question, looking at this question, your monthly demand is what?
$400, $500, $600.
Your monthly demand of material X is
It's
what?
1,000.
1,000.
1,000 units.
1,007.
1,000 units. Your annual demand will be what?
Which
12,000.
12,000.
12 times 1,000.
So your ordering cost per order is what in the question?
$30.
And your holding cost is
2.88,
It's 2 naira.
which is also our carrying cost.
so now the question wants you to calculate
Finish the one you're not.
the total cost of buying the material in quantities of 400, 500, or 600 units. The question wants you to identify the cheapest option. So for us to do this, we'll use a table to solve this. Please follow because I have another similar question that we need to solve. We have solution. The order quantity. Order quantity. Now, based on the orders, we can have 400 units. We can have 500 units. We can have 600 units. 600 units. Now, for you to solve this, you need to identify your average inventory. Your average inventory for each of these units is what? For 400 units, your average will be what? Will be 200. For 500 units, your average will be what?
250.
And for 600 units, your average will be what?
300.
Now, you need to also ask yourself, what will be the number of orders per annum? If I'm buying 400 units, if I'm buying 500 units, if I'm buying 600 units, how many orders will I make? So the question is, I asked a question earlier on that in a month, we are demanding for how many units of material? 1,000. In a year, it will be what?
12,000.
12,000. 12,000.
12,000. Fine. Now, if you need to buy a unit of 400 units every batch, and you need 12,000 units in a year. If you are buying 400 units per batch, how many batch will you have? Or how many orders will you make in a year? This is what problem? It's not any problem. It's not problem. Tell me the answer.
30 orders. I don't know.
Okay. 30 orders.
30 orders. 30.
Yes, very good. 30 orders. Let me explain again. Some people are already looking. What is this? Going to the question. A company requires 1,000 units of material X per month. Now, in a year, how many units will they need to buy? 1,000 times 12, right? You have 12 months in a year. 12 times 1,000. You have what? You have 12,000. Now, if you are making an order of 400 units, anytime you need goods, you need the raw material. If you are making an order of 500 units, anytime you need the material. If you are making an order of 600 units, anytime you need the material. How many orders will you make in a year if you are buying 400 units per order?
So divide by 400.
Number of orders. So this, if you are getting 400 units per order, how many orders will you have in a year? Number of orders per annum.
30 orders. 30 order.
So you have 12 divided by what? 400. You have what? 30 orders. If you are getting 500 units per order, how many orders will you have in a year?
24.
Sorry, sir.
I'm with you, sir.
I thought the question read the cost per order is 30, regardless of the size of the order.
Yes, sir. We
I
are
think we are
coming
not.
there. We are coming
not-
there with it.
Okay.
It's when we are talking about ordering costs. We'll now go and look for that 30.
Okay.
But now I want to know the order. If you are getting 400 units per order, what is the total order in that year?
Okay. Okay. Another question. What is the essence of this average inventory?
The essence of the average inventory, for you to get your holding cost, you need the average inventory. So we are coming there too.
Is okay.
So now, for 600 units, your number of orders per annum will be what?
20.
20.
So we have it as 20. 20. We have it as 20. You have it as 20. So now, the next thing to do is to ask ourselves, what will be our holding cost? What will be our holding cost? Now, your holding cost is your average inventory multiplied by what? Holding cost per unit. Your average inventory multiplied by holding cost per unit. Now, how do you get your average inventory? It is the order quantity divided by what? Divided by 2. The order quantity, this is the order quantity, 400 unit here. When you divide by 2, you have 400. You get your average inventory. Order quantity is what? 500 units. In that order. So, to determine your holding costs, for 400 units, what are you going to do? when it is 400 units, what is the formula for holding cost? For holding
It
cost.
will give you 576. That's 200 times 2.88.
Okay.
100.
So holding cost, your average unit, average inventory now, multiply by what? Multiply by what is the cost? The holding costs in the question.
2.88.
2.88. Multiply by 2.88. So when it is 400 units, your average inventory is what? It's 200. 200 multiplied by your holding cost, which is 2.88. You're going to have what?
576.
576. When it is 500 units, your average inventory is what? 250. 250 multiplied by what? 2.88. The outcome will be what?
720.
720. And when it is 600 units, the average inventory is what? 300 multiplied by the holding costs, that is 288. You're going to have what?
864.
864.
864. The essence of showing deals is for you to know how to determine your holding costs, for you to know how to determine your ordering costs. In most questions, they will just give you free of charge. Where it is not given free of charge, understand these concepts. That is why I'm bringing this. I'm not just bringing a question where they will give you free of charge. So we are working to see how you can derive those things where you are not giving. That is the essence of solving this question. So determine your ordering cost. What are you going to do? Ordering costs. This should be a very clear one. Your ordering cost will be what? Your number of orders. Number of orders. Multiply by what? Ordering costs. The costs per order. The costs per order is what? $30.
Multiply 400.
$30. So per order. So now for when it is 400 units, the number of order is what?
12,000.
30 multiplied by 30.
900.
900. That is this is the number of orders. That is 12
I can see the screen again.
Is equal to 30. I'll share my screen again. So I've shared my screen again. You should be able to see it now.
I can see it now. It's clear.
All right.
Thank you.
So when it is 500 units, your ordering cost will be what?
30 multiplied by 20.
30.
So you have it as what?
720.
120. When it is 600 units, your ordering cost will be what?
20 times 30.
And this will be what?
600.
Now, what will be your total cost? When it is 400 units, your total cost will be what? Hold it first. What are the cost elements in what we've solved? Let me know. what are the cost item here?
Coding cost and
Coding
ordering
cost
cost.
and ordering cost.
Very good. So your total cost will now be what? When it is 400 units,
It's 1,476.
1,476.
and when it is 500 units, the total cost will be what?
1,440.
1,440.
And when it is 600 units, your total cost will be what?
1,464.
1,464.
Define.
Now, if you are to, as a financial manager, based on your knowledge of inventory management, the essence of inventory management is to see what units can you order per batch that you minimize cost.
500 units.
Very good. 500 units. It means the best order we can make in every order is better we go with 500 units because we have the least cost here of 1,440 compared to 1,476 compared to 1,464. And that is where I said note the other time. That notes the overall objective of inventory control is to maintain stock levels so that the total relevant cost of inventory are at what? Minimum. At minimum. So now the minimum from our computation
Rose, mute yourself, please.
I'm not talking. No noises from my side. Let me.
any question? I can see your hand up. This here.
Okay, sir. Sorry, sir. I don't know. Does this apply, or are we still going to do that EOQ? Because I did EOQ without 1,000 times the 2 times 30 divided by, and I'll still get that exact 500 units. So I want to
Yes,
know.
we are coming there. So from the question, it is we are required to make a decision that will be beneficial, that when we order 500 units per batch, we'll minimize our cost by incurring 1,440. But when we go for 600 units, the cost will be high. When we go for 500 units, the cost will be high. For 400 units, the cost will be high. So it's better we go for the option with the least ordering cost or total cost. Going back to the question, required, investigate the total cost of buying the material in quantities of 400, 500, or 600 units at one time. What is the cheapest option? The cheapest option is when you buy at 500 units. That use the economic order quantity formula to prove your answer is correct. So the economic order quantity formula is what? Is this. The economic order quantity formula is this. So based on the formula, 2 will always be constant. 2 is constant. So your EOQ Your EOQ will be what? From the question, what is your D? You know, we said
12,000
D is what? Annual demand.
demand.
From your computation, your annual demand will be what? 1,000
12,000 times
multiplied by
12.
12,000.
So we have it as 2 multiplied by 12,000, which is your D. Your CO is what? Ordering cost.
30.
Ordering cost or cost per order. The cost of ordering one. From the question, the cost per order is what? $30. So you have it as multiply by what? 30. Multiply by 30. Your everything here divide by your
Holding costs.
divide by your carrying cost or cost of holding 1 unit for 1 year. So from the question, your carrying cost or holding cost is what? 2.88 per year.
2.88.
So when you divide by this outcome here, 2.88, then note they are all in the square root, please. So when you do that, what will be your outcome?
500, sir.
So we have 500 units. 500 units. 500 units per order. 500 units per order. For those that might be wondering, your CO is equal to 30. Your D is equal to 1,000 multiplied by 12 is equal to 12,000. Your holding or carrying costs is equal to 2.88, all given to you in the question. So some questions will just give you these values and say determine the economic order quantity. Yes, but this question have gone further to try to make us understand something. So let's look at another one that you are going to solve yourself. Let's come up with another question now. Please take down this question. Olainka has a demand for 4,000 or 40,000 desks. A demand for 40,000 desks per annum. The purchase price of each desk. Purchase price of each desk is Purchase price of each desk is 25 naira. There are ordering costs. There are ordering costs of 20 naira for each order placed. For each order placed. Inventory holding costs. Inventory holding costs amount to 10%. 10% per annum of inventory value. Of inventory value. Calculates the inventory costs per annum for the following other quantities. The following other quantities. So we can have A and have 500 units, and have B can have 750 units, can have C can have 1,000 units, and have D can have 1,250 units. So this is a question that we should be able to solve. It's a question that we should be able to solve. So now, I believe this question is clear. So we'll talk about just in time. Just in time, this concept is a concept that is popularly used in industrialized nation. That's instead of, yes, Madam Macaulay.
Sir, is this an assignment?
It's an assignment, ma.
Okay, I
At
thought it's
least
casual. I thought
you can.
Thank you, sir.
Okay, you can even send it before tomorrow morning, ma.
Thank you, sir.
So the just-in-time system is an inventory management system where materials are purchased or produced only when they are needed, not in advance. That is just in time. It's also in performance management. When you are reading those theoretical aspects, you see it just in time system. What is the idea about this just in time? What is the idea?
To avoid wastage.
Oh, yeah. What?
So the idea about this just-in-time system is that we shouldn't have any stock sitting idle. That as production is required, we make an order for our raw material. As the raw material arrives, we use it. Madam Macaulay, I can see your hands up.
I'm sorry, sir. I didn't drop my hand.
Okay. So, just in time is a series of manufacturing and supply chain techniques that aim to minimize inventory levels and to improve what customer service by manufacturing not only at the exact time customers require, but also in the exact quantities they need and at a competitive price. So it's not just you producing because the customer requires it. No, you are producing based on what they need. Not when you produce, you say you have leftover. No, there's nothing like leftover. There's nothing like reserve. The quantity that is required is the quantity that is being produced. So just as we've asked ourselves that why just in time is to ensure smooth flow of work through the manufacturing process. So to ensure flexible production process, which is a response to the customer's requirements and is a way to help an organization avoid tying down its capital in inventory. You can relate this to yourself. If you don't want to keep holding cash in your hands, anytime you need cash, you move to the nearest ATM machine and you get your cash because you don't want to hold cash in physical. But the implication will now be if you don't have ATM close to your house, the ordering cost, the cost of getting those money anytime you need it, you will need to consider that. That is what we just treated. So just in time involves the elimination of waste, such as materials mishandling, long raw materials lead times, long customers lead times, unnecessary clerical and accounting procedures. In most organizations, before you get your raw material, even though you are working in the same organization but different departments, you know the official activities that takes place. 1 minute on memos to another, all to ensure what? To ensure proper documentation. So those official and bureaucratic process will be removed with just-in-time system. So all activities performed that do not add value to the company will be eliminated. So it's only those things that will add value, instantaneous value, that will be considered. So just-in-time system attempt to eliminate waste at every stage of the manufacturing process. So this is the concept of of just in time. The concept of just in time. So the simple explanation is that instead of stocking large quantities, customer place an order, production starts immediately, materials arrive just in time for use, finished goods are delivered quickly. So no excess storage, no long delays. So that is the just-in-time concept as it relates to inventory management. The advantage is that there is lower holding costs. You incur less rent. You pay insurance less official insurance payments. You experience issue of less deterioration, spoilage, and it's helped to reduce waste. You will not have cases of expired products. When you have too much goods in your warehouse and you have different brands, definitely there will be some brand that will not move very fast. And if you are not careful, some of those goods will become expired in your warehouse. And that is when you will now see some organization they will be doing promo. They will say buy one, get two, buy one, get three. All those are because of some of those goods will still expire. So in order not to lose wholly, they will now adopt a marketing strategy whereby they will try to move those goods out of their warehouse by adopting a way that people can buy in a very fast way. So the just-in-time help to remove such unnecessary pressure on the marketing department. And more so, with just-in-time, you have improved quality control. There will be less defects, and the defects will be detected early. Because as you produce, you are sending to your customer. So if there is any issue, immediately you get a feedback, the customer's feedback. But when you produce and you store in your warehouse, to take a long time before you discover any error, any production error. And the disadvantage would be what? What are the disadvantage? Can I get a response? From what I've stated as advantage, what do you think would be the disadvantage?
Maybe out of stock. When you're out of stock.
There is high risk of stock outs.
Mm.
High risk of stock outs. Because any delay in availability of raw material can stop what? Production. Because this system will work in a perfect economy where things are working rightly. Do you think this system will work in our country?
Maybe not.
No.
So
Maybe when you have a trusted supplier, that's when it can work.
So in this country, can you beat your chest and say you have a trusted person?
No.
Not
No.
really.
No. Big no. Everybody telling me big no from their experience. Even the person you say you trust, you should still have some level of doubt in your mind. And this
There may
person
be
can
a
fail.
case of machine breakdown, sir.
Yes, there can be case of machine breakdown.
Yes.
I think it will
Unreliable
be more
customer.
expensive.
Sorry, you said what, Madam Ruth?
I said unreliable supplier.
Yes. So when you rely on your supplier, there can be late delivery sometimes, and that can result into problem. It can be late delivery, and God help you, you don't have a substitute to cover up for such delays. You will lose goodwill.
A loss of customers,
and loss of customer,
loss of revenue,
loss of revenue.
It can also lead to loss of staff
Yes,
and trading secrets.
yes. So this just-in-time system, it requires good planning and technology. Yes, it does. It will not work in a country where the network is fluctuating. You're having a clash. The network is pulling you out. You want to place an order, the network is not available. So for just in time to work well, go and dispatch, your experience hold up. For those of you in Lagos, what are those red flag area for hold up? Tell us.
Ikorodu Road.
Lekki,
Okay. See? So
Tom Island Bridge.
when you produce in Ikorodu and you are going to Lekki, you can imagine the number of hours, and you cannot fly by air. So there must be efficient transport system, and also there must be good communication systems, and there must be high quality production process for just in time to work as expected, for it to work as expected. So the subject matter is this. Question can come in scenario form to test your understanding of the concept of just in time. And you can also be tested on the issue of economic order quantity. Yes, like there is a question from the past examination, especially in SFM, that asked us that what is meant by a just-in-time system, and describe briefly 4 of its main features. 4 of its main features. And so also in this question, the question is asking us to calculate the economic order quantity. If changes, there is a scenario question anyway. With time, I'll make it available to you. There is a scenario question whereby you have an existing customer and a new customer. So you're trying to compare what the economic order quantity will be if you go with the new customer or you stick to the existing customer. So the concept we've learned this evening is very important. In case it's still doing you like a magic, you can go over it again and see how far you can understand. So I also have another question on just in time that is testing your understanding. Yes, on the features of just in time system. On the features of just in time system. So I'll make the question. Then you can also go to the FM question and answer kit I compiled. Question on economic order quantity, because I know a student have asked order quantity. She was solving and she was finding certain things difficult. Yes. So you also see question on what we've discussed in that question and answer kits there. So you can do well to solve questions, but please, I'll emphasize cost of capital, investment appraisal. If you know you don't know those topics, go back and watch the videos again. They are very important. Cost of capital, investment appraisal. Please go back and in case you know you are not strong on those topics, go back to them again. They are very important. It's not during revision time you start jumping up and down. No, I don't work that way. Go back to them again. This is the time now. Yes. So for next week, I don't know. Okay, let me stop the recording before I say